Today, to the moon and beyond, the Property Imperative Weekly to the 20th of July 2019. Hello again, it's Martin North from Digital Finance Analytics. Welcome to the latest weekly digest of finance and property news to the 20th of July 2019, with a distinctively Australian flavour. And in the week that we're celebrating the 50th anniversary of the first moon landing, yes, it really did happen despite the conspiracy theories, it's worth considering that on so many fronts, the finance and property news signals extremes, hence to the moon and beyond. Debt has never been so high. Stock market indices are reaching for the stars as central banks continue to push rates lower to sustain the debt-driven excesses longer. And locally, the bank regulator was called out as an ineffective regulator as the banks pushed their lending standards lower in an attempt to drive home prices higher despite the impact on household debt. And as the government cheers them on from the sidelines and tells the people to take the risk. What could possibly go wrong? So we'll start with the bellwether US market because what happens there will impact us here. Now I note that some viewers complain about this, but context is everything. But if you want to jump directly to the local news, the time is shown below. On Friday, US stocks were lower following a report that the Federal Reserve plans to cut interest rates only by a 0.25 percentage point at the end of the month. This follows remarks from New York Fed President John Williams on Thursday, which appeared at first blush to signal a bigger rate cut. But this was later clarified. Futures markets odds of a 50 basis point cut in the Fed's July meeting soared to 71% late on Thursday, immediately after Williams' speech, but then fell to 22.5% on Friday. The market is all but 100% firm on this cut later in the month. Also, the expiration of options on Friday amplified the market reaction to the report. Then what started as a stock market rally early in the session was mostly wiped out by rising tensions in the Persian Gulf. The catalyst was a report that Iranian authorities had seized a British tanker passing through the narrow Strait of Hormuz, which connects the Persian Gulf to the Indian Ocean and is a critical passage for global oil supplies. Crude oil prices surged in New York and London, creating worries enough to pull stocks back. West Texas Intermediate crude oil closed at $55.75, up 0.45%, but was still trading higher later in the aftermarket. And the performance was worse than it could have been because there was a 4% gain in shares of Boeing, which added nearly 110 points to the Dow. The Dow Jones Industrial Average fell 68.77 points to 27,154. The S&P 500 lost 0.62% to 2,976, and the Nasdaq Composite dropped 0.74% to 8,146. For the week, the Dow lost 0.64%, the S&P fell 1.23%, and the Nasdaq shed 1.19%. Second quarter profits at S&P 500 companies are now estimated to rise about 1%, in a reversal from expectations of a small drop earlier on. And US President Donald Trump reiterated his threat to impose further duties on Chinese imports. The two sides resumed talks recently to seek an end to the year-long trade war that has rattled financial markets and slowed global growth. But most analysts do not expect an agreement anytime soon, and some are predicting a strong risk of future tariff escalation. But still, the S&P 500 is up 18.7% on the year, and the Nasdaq has gained almost 22.8%, and the Dow is up 16.4%. And this is all about lower rates from the Fed. Indeed, President Donald Trump called on the Federal Reserve to cut its key rate at its July 30-31 meeting, arguing rates had held back the economy this year. The US 10-year yield was up slightly on the day to 2.057%, and the yield is down 3.5% on the week and 23.8% of this year. However, the 3-month rate was at 2.071%, so it remains higher than the longer rate, which continues to signal trouble ahead. The Volatility Index, which measures the implied volatility of the S&P 500 options, was up 6.8% to 1445, so risk is on. And next week will produce a flood of earnings reports that will be heavy on banks, but it will also include some of the big tech names, including Facebook and Amazon, Google and Intel. Global stocks rose on Friday as investors firmed up bets of a US interest rate cut at the end of July, and this is fueling the appetite for risky assets and capping the dollar. European shares opened higher across the board, with the Pan-European Stock 600 index gaining 0.7% in early trade, but then settled at 387.5 and flat. And Britain's FTSE index gained 0.21% to 7,508, as the Fay election for Prime Minister runs its course amid concerns that a forced Brexit could cut 2% of UK growth, and the Parliament tried to impose restrictions on what a future PM may do. As analysts digested the latest turnaround plan for Deutsche Bank, essentially trying to cut more costs than revenue generation, it ended at 6.902, down 1.73%. Many are saying it is not enough to resolve the myriad issues the bank faces. Elsewhere, the euro-US dollar was down 0.47% to 1.1222, and the US dollar index futures was up 0.38% to 96.81. Weaker than expected German PPI pushed the euro-US dollar lower, and the ECB meets next week, and they are expected to set the stage for easing. The US dollar traded higher among all the major currencies on Friday. Gold futures for August delivery was down 0.13% to 1,426.30, and spot gold eased as investors locked in profits after bullion surpassed $1,450 an ounce for the first time in more than 6 years on dovish Fed signals and Middle East tensions. And so to the cryptos. On July the 16th, the Bitcoin price reached a high of 11,058. The next day, the Bitcoin price reached a low of 9,084. And after reaching a similar low the next day, the price began to rapidly move upwards again. And as we write, it is back to 10,498, down just 0.8%. Analysts are split on whether this volatility is a signal of more falls ahead or something else. Indeed, some are drawing parallels between the recent moves and the last significant correction. Certainly the patterns appear similar, and the charts do seem to suggest more downside than upside. So, although the breakout was supported by massive trading volumes, perhaps the price will soon continue its downward movements. Frankly, the significant recent volatility makes it increasingly unclear as to which direction the Bitcoin is heading, and it may even make it more difficult to know whether the bulls or the bears are in control. And more broadly, Facebook's Libra is attracting scrutiny from Congress, concerned about money laundering and other issues associated with cryptocurrencies. But, properly managed, Libra poses a bigger challenge. It could actually replace the dollar as the currency of choice for legitimate international transactions. The white paper actually represents an impressive list of corporate backers, but it leaves out many details about how its infrastructure would work and be safe against criminals and rogue regimes, like the drug cartels and North Korea, both of which use Bitcoin to circumvent economic sanctions. Like Bitcoin, Libra would enable computer payments via blockchain technology. Consumers would buy Libra with dollars and other currencies. Facebook's 2.4 billion users would give it unrivaled potential for broad acceptance by merchants and governments for tax payments, especially in developing countries where many lack access to reliable banking. What sets Libra apart from Bitcoin is that it will be backed by strong companies and genuine assets. Consequently, Libra would be backed by reserves, just like the fiat money issued by governments. Only the dollar as the ultimate reserve currency has no substantial backing other than the limited amount of gold and foreign currencies and the full faith and credit of the US government, whatever that's worth. The values of national currencies, including the dollar, fluctuate a lot, one against the other. With so many goods purchased on global markets, misguided monetary, fiscal and trade policies, recessions and political upheavals can diminish the purchasing power of any of them, including the dollar. The Libra has the potential to mitigate this problem by being pegged to a diverse basket of national currencies that could provide ordinary people in developing nations a better alternative to local currencies, and the dollar to store wealth and invest. It could be substantially immune to capital controls. And bitcoins are created mostly by users solving complex mathematical problems, and are backed by nothing but a promise, and have no significant international institution to protect the integrity of its payment system against hackers and fraudsters. Users have taken big losses, and it fluctuates wildly in value. Bitcoin is easily copied, and a plethora of similarly flawed cryptocurrencies have emerged. Libra, on the other hand, should benefit from the network effect. It will pay for merchants and consumers to gravitate to one digital platform. If Libra's backers don't get it right, others will follow, if governments let them. But so far, the Federal Reserve has limited access to digital money to banks, hedge funds, and money managers that run investment funds. If government regulators did permit Libra to flourish by treating it as a currency, then ordinary people would have something the Federal Reserve only permits bankers and other financiers to enjoy: genuine, stable digital money. And with digital economies increasingly moving away from cash to electronic transactions, the stability offered by valuing Libra against a basket of currencies could give it great utility for writing international commercial contracts, especially multi-year delivery agreements. Plus, US allies are becoming disenchanted with Washington for the overuse of economic sanctions, for example, excluding Iran from access to the payment systems of US banks, and are seeking workarounds. Incorporated and governed from Switzerland, a widely accepted Libra could be just the ticket. And then private money, the Libra, could effectively supplant the dollar as the currency of choice. The stakes are very high. So now to the local scene. Central stage was the issues relating to construction standards and faulty new buildings. The Sydney Morning Herald reported that an Erskineville apartment development remains a ghost town more than 12 months after it was completed, with the City of Sydney refusing to allow owners to move in over fears the developers did not properly clean up toxic land underneath it. The 109 Sugar Cube apartments and the 18 honeycomb terraces were built at the old Ashmore Industrial Estate. The Herald's revelation that owners have been prevented from living in a fourth Sydney apartment building over safety concerns comes less than 24 hours after an emergency meeting between the state and federal governments over the country's building standards crisis. The Zetland, Massacre, and Opal Tower apartments across Sydney have all been evacuated in the last 12 months due to major defects. And, by the way, there are no known defects in the Erskineville development at this stage. And ahead of that national reform announcement, the Victorian government announced $600 million to help cover the costs of rectifying around 400 properties in the state, about 1/3 of those audited for high-risk dwellings, not so far covering, of course, any commercial buildings. Half may be recovered from higher building levies, as the federal government refused to fund the $300 million. This issue will run and run, as it is a countrywide issue thanks to the deregulation of standards a decade or so ago. The bill will run into billions and take years to fix. The supervisory approach also needs attention. And it also begs the question of what happens to those residents who have already spent to fix their buildings. Also, when cladding is removed, what lies beneath? New South Wales peak strata body warns that Sydney apartment owners are facing a $1 billion repair bill to replace the dangerous flammable cladding, and has called on taxpayers to pay. In the Sydney Morning Herald, Mr Duggan estimated that the $1 billion was a more appropriate figure to remedy the more than 600 buildings affected by combustible cladding. Enough is enough at this point in time. We've got, he said, a systemic crisis at the moment across New South Wales with defects, cladding, and issues that are all stacked against consumers. He said it did not matter whether the emergency funding package came from the state or federal government, and that a building ministers forum this week, state, territory and Commonwealth ministers announced a unanimous decision to establish a national approach to implement recommendations made by the landmark Shergold-Weir report. Building confidence, a new national approach, will see an expanded role for the Australian Building Codes Board, the ABCB, and establish a dedicated implementation team under the aegis of the ABCB. The implementation team will include both government and industry representatives, and they say it will drive implementation of the Shergold-Weir report's recommendations, including potential changes to the National Construction Code, the NCC. As part of the change, the ABCB strategic plan will be recast and the organisation's capabilities further strengthened to meet its expanded role and responsibilities. The announcement today, they said, is a significant step forward for both the building sector, including fire protection, and paves the way to deliver an important program of reforms. The community's trust in the building sector has been eroded, and there is a lot of work to do to restore it by both industry and government. Now, to my mind, this is all too little, too late. The certification deregulation and the dilution of materials controls means that thousands of buildings, both corporate and residential, are under a cloud. Residents are being kept in the dark as to which buildings are at risk, and property values are being impacted negatively. And remember, as the ABC reported a few years ago, imported panels can contain up to 10% asbestos, yet still be used in new buildings in Australia. And believe me, the results of exposure to asbestos are life-threatening in the longer term. This is a further disgrace. There is just too much papering over the cracks, both literally and metaphorically. And in fact, we first featured this issue on DFA more than a year ago, before it was widely acknowledged. And even now, politicians are trying to blame each other. Crappy construction is a national issue and a national disgrace. And talking of national disgrace, the report on APRA, which was released this week, was damning. Whilst the report applauded the regulator's focus on capital improvement in the banks, which, by the way, was driven by the previous financial systems report under David Murray, not APRA itself, pretty much everything else is broken. They prefer to work in secret, behind the scenes. They are too close to the big banks. Their culture means that they are ineffective, and I could go on. And they also suggested separating the superannuation supervision from their other roles. How Wayne Byers, who recently had his contract renewed by Josh Frydenberg, can maintain any credibility is a mystery to me. Indeed, John Dalson and I discussed the consequences of this in our post, Why APRA is Not Fit for Purpose. It tells us much about the broader deficiencies within the regulatory system across APRA, ASIC, and the RBA and Treasury. Given the cultural deficiencies that were spotlighted in the Hayne Review within the banks, how on earth can an entity with its own massive cultural issues maintain any credibility at all? And, by the way, talking of credibility, we received heavy flack from a number of politicians relating to our post on the economic and social crisis evidence in Mandurah, Western Australia. John Adams and the CEC's Robbie Barwick and I spoke about this initially in our post, The Economic Massacre of Mandurah, and a follow-up post with Western Australian MP Charles Smith MLC entitled The Perth Disaster is Heading East. But local pollies, from federal members to the local mayor, all tried to dismiss the claims we were making, as we pointed to high unemployment and crime, as well as many properties being for sale, and average prices falling some 30%. So then we made a second show, The Mandurah Establishment Attacks Adams and North, and we stand by our research, and we're not picking on Mandurah particularly, rather we are highlighting the direct links between high debt and broader social issues, and we've been seeing similar patterns emerging elsewhere, with mortgage stress clearly a leading indicator. Once again, the establishment prefers to look away and just preach more of the buy now, It's a great time to buy mantra. In fact, Housing Minister Michael Sukkar went as far as, I think, giving financial advice, saying now was a time to risk buying a property. See, anything to inflate the debt bubble some more. And of course, Westpac and ANZ have started to lower the interest rates they use to stress test customers' loan applications in an attempt to help, quote, stabilise, unquote, the house prices in response to APRA's loosening of mortgage lending rules. These were, of course, introduced by the prudential regulator earlier this month. Westpac now assesses the serviceability capacity of its customers using the lower of 2.5% over its lending rate or a minimum 5.75% floor test, according to its website. And that compares with a 7.25% minimum test rate the bank was using before the regulator removed the mandated floor. ANZ told clients that its new floor rate for retail lending will fall to 5.5%. A spokeswoman for National Australia Bank said now is the right time to change the approach to how the affordability rate floor is determined given the continuing low interest rate environment. She did not reveal the new testing rate applied by the bank. Now, according to some analysts, every 1% drop lets home buyers borrow up to 10% more. But it's actually not that simple, as there are still tighter responsible lending obligations. And the RBA has said it does not expect a material pickup in borrowing. And CBA on Friday said it would ease mortgage lending rules for its customers starting on July the 22nd, joining the party. It will introduce a new 5.75% floor rate and a 2.5% interest rate buffer in line with APRA's. So far, the changes have not reflected, though, in any significant uptake in lending. But then the stats are weeks behind. However, according to NAB, foreign buyers may be returning at the margin. They said that the trend decline in foreign buyers of Australian residential property over 2018 and into early 2019 can be attributed largely to the crackdown on capital outflows in China in recent years and to local state government charges on foreign buyers and stricter lending limits by Australian institutions. But this trend reversed in the second quarter, with the market share of foreign buyers in the market rising to 7.1% in new properties from 4.9% in the first quarter and to 4.1% in established markets from 3.5% in the first quarter. Now, while this may just be a blip on the radar, weakness in the Australian dollar, further declines in domestic house prices, particularly in key cities, and more recent political unrest in Hong Kong may have reignited some interest in the Australian market, they said. And CoreLogic reported that home prices in some places are stabilising or even improving, on average a little. But Perth has now dropped below 20% peak to trough, and rentals in the West are down around 22%, according to the ABS. So firstly, let's look at the CoreLogic annual series. You can see there that Sydney has dropped more than 10% and is just moving up very slightly now. Melbourne, a somewhat similar pattern, whereas Brisbane continues to slide lower. Adelaide is also beginning to drift lower now, and Perth continues to take a further dive. So the overall 5 cities index is just very slightly higher, and it's worth reflecting again on the fact that these are averages and that within each location the property movements are much more diverse. We're still seeing many centres where prices are 20 to 30% lower, and we're also seeing some postcodes where prices have hardly dropped at all. And in terms of the individual movements up to the 18th of July 2019, in Sydney, over the last week, prices are up 0.18%. Over the quarter, they're down 0.6%. Over the last year, they're down 9.4%. And from peak, they're now at 14.8%. In Melbourne, over the last week, they're up 0.14%. They were down 0.19% over the quarter. They've dropped 8.6% over the last year and are down 10.9% from peak. In Brisbane, prices fell 0.04% over the last week. They're down 1.13% over the quarter. They're down 2.6% over the last year, and from peak, they're down 2.7%. In Adelaide, they fell 0.09% over the last week. Over the last quarter, they're down 0.34%. Over the last year, they're down 0.6%. And from peak, they're down 1.1%. In Perth, they fell 0.3% over the last week. Over the quarter, they fell 2.35%. Over the last year, they've fallen 9.2%. And from peak, they're now 20.2%. That's one of the most significant falls that we've ever seen. And in the major five, the last week movement was up 0.08%, over the quarter down 0.75%, over the last year down 7.9%, and from peak down 10.8%. And the auction clearance rates may be a little improved, but on stubbornly low volumes. Total reported auctions were 732 last weekend, compared with 1,178 a year back. So the 72.8% in Sydney and the 70.6% in Melbourne are misleading. In addition, a number of auctions never happened, and those are not included in the figures. And some other information providers have started to include Central Coast and Wollongong data in their Sydney numbers. The numbers are artificially inflated. And CoreLogic also showed that there were 17.5% fewer sales than the previous year, with an estimated 412,000 settled dwellings over the past 12 months. Sydney recorded an estimated 82,400 settled sales over the 12 months to June 2019, down 21.9% than the previous year, and well down on the decade average. The 6-month trend for Melbourne showed that the estimated number of sales trended slightly higher over recent months. Notwithstanding the recent improvement in transaction volumes, market activity has fallen to levels similar to those during the 2011-12 housing downturn. Annually, there were an estimated 64,500 settled sales over the past year, which was 27% lower than the previous year. And unlike Sydney and Melbourne, there is little evidence as yet to indicate that transaction volumes in Brisbane may be stabilising. Transaction volumes continue to trend lower on a monthly basis, and although they are similar levels to those in 2008-9, they are not yet as low as the volumes that happened during 2011-12. Over the past year, there were an estimated 39,600 settled sales across Brisbane, which was down 13.4% compared with the previous year. As the ABC put it, the house of cards looked to be teetering, with double-digit price falls in Australia's two biggest cities, Sydney and Melbourne, over the past couple of years. But now policymakers have pulled out all the stops to halt the market slide. Interest rates have been slashed to record lows. Lending restrictions have been loosened, and the government is offering to help first home buyers buy with a very low deposit. The early signs, the ABC said, are that this is working, with price falls easing and now even reversing in the two biggest cities. But house prices in these cities remain out of reach for many aspiring buyers, while debt levels around the country remain at record highs. This has many analysts worried that Australia's house of cards only needs to see a run of economic bad luck to come crashing down. And again, via the ABC, a veritable army of tipsters have called the bottom over recent weeks. They include property analyst firms SQM Research, Domain, and CoreLogic, AMP Capital's chief economist Shane Oliver, who was one of the first to tip a big downturn, and the BIS Oxford Economics, and ANZ, and even the Reserve Bank, who said conditions in the established housing markets of Sydney and Melbourne had improved a little since the previous meeting. RBA board members noted at their last meeting housing prices have stabilised in June in these cities, and auction clearance rates had picked up further, albeit still on low volumes. And as the ABS also showed, it's not just the experts. More consumers now agree that house prices are about to turn around, and where expectations go, the ABC said, prices usually follow. But that does not necessarily mean prices will rebound, although Oxford Economics were quick to predict a 20% lift in Brisbane over 3 years, and smaller rises in Sydney and Melbourne, with just 6% in Sydney between now and 2022, still leaving prices 13% below their previous peak. And it forecast in Melbourne a 7% rise with prices remaining 10% lower than the peak over the next 3 years. And now, in more economic news, employment growth was pretty sour, with just 500 jobs added last month, well below expectations, which were around 10,000 jobs. As the participation rate held up to its historic high of 66%, the unemployment rate also remained unchanged at 5.2%. Interestingly, underemployment, those who are willing and able to work more than they currently do, instead fell in the month from 8.6% in May to 8.2% in June. But this looks to be a one-off fall that reversed a similarly sized rise in April. For the economy overall, it is important to highlight that at 5.2%, the unemployment rate is well above the RBA's 4.5% full employment target. And despite June's reversal, underemployment is still materially above its post-GFC high. It's hard to see how the RBA's target will be reached. And Roy Morgan's alternative measure continues higher, saying in June 1.25 million Australians were unemployed. That's 9.2% of the workforce, with an additional 1.28 million, or 9.4%, now underemployed. Unemployment was up 83,000 on a year ago to 1,254,000 Australians. An additional 1,275,000 Australians, or 9.4% of the workforce, are underemployed, working part-time and looking for more work. A decrease of 27,000 in a year, down 0.3%. The Roy Morgan survey defines any respondent who is not employed full or part-time and who is looking for paid employment as being unemployed. This is broader than the ABS number, which is more narrowly defined. And finally, the ABS showed that the proportion of households mortgage-free continues to fall, as more are excluded completely from owning and have to rent. Whilst more households have a mortgage which is bigger and held for longer, many still in debt in retirement. And so those households are much more exposed, a direct result of the massive debt build-up and the chase up in house prices. Yes, the very same locations where now the kitchen sink is being thrown to try and persuade more to borrow, debt to the moon and beyond. And finally, to the markets. The ASX was up 0.74% on Friday to 5,539 and up 22.39% in aggregate over the past 3 years, while the Dow in comparison was up 46.03% over the same period. On the other hand, the financials index locally was up just 5% over 3 years and up 1.07% on Friday to end at 6,343, compared with the US financial index, which was up 46.13% over the 3 years. ANZ closed at 27.38, up 0.26%, and is 8.5% higher compared with 3 years ago. CBA ended at 89.09, up 0.71%, and up 6.94% over 3 years, despite more class actions emerging, which are centred on money laundering. NAB closed at 27.51, up 2.91%, thanks to the announcement that they hired the man credited with turning around the Royal Bank of Scotland as its new chief executive, as it moves on from the abrupt departure of its leaders this year in the fallout of the misconduct inquiry. New Zealand national Ross McEwen is the outgoing CEO of Britain's RBS and has also held senior roles at CBA. He joins NAB as the number 4 bank, and its peers fight to win back customers' trust after damaging findings at the Royal Commission inquiry into the financial sector. NAB for 20 years or so has been underperforming, so there is a lot to do when he joins next year. In fact, NAB is just 5.3% higher than 3 years ago. Westpac was up 0.3% to 27.88 and is down 8.23% compared with 3 years ago. And talking of falling value, the Bank of Queensland is down 11.2% over the same 3 years and ended on Friday at 9.12 and is up 0.55% on the day. AMP got hit hard when the Reserve Bank of New Zealand intervened to stop their wealth business sale. As a result, AMP stood at 1.79 on Friday and down 68.98 over the past 3 years. This highlights the massive shareholder destruction underway at the moment. On the other hand, Macquarie Group ended at 127.29, up 0.47%, and is up an amazing 73.8% over the past 3 years. The Aussie ended at 70.39, a little stronger, but down 0.52% on the day and down 5.88% over the past 3 years. And the Gold Aussie Cross was at 2,023, down 0.98% on the day, and the Aussie Bitcoin cross was at 14,970, down 0.99% on Friday, but up 184% year to date. So in summary, we see the drive for more debt-driven expansion is still intact, and in Australia that means more households picking up ever more mortgage debt, with most commentators wishing to talk the market higher. But risks continue to build. Of course, the question remains how such debt can be repaid, as more households go into retirement with mortgages around their neck, and more households will be renting into retirement. This is unsustainable, and as I discussed with Steve Keen recently in a conversation with Steve Keen Part 1, The Debt Problem, we need some different strategies to deal with this planet-sized problem. In our other 3 episodes, we also explore the consequences more widely. I hope more households wake up to the fact that they are being used as cannon fodder by the government and by the RBA to try and prop up the economy. Just as the moon gets bigger the closer you get to it, so the impact of debt comes to dominate. And I fear that the Mandurah story is set to be repeated elsewhere. And just before I go, I just want to acknowledge the very large number of messages that I've received from viewers relating to wishing my wife well. She's still in hospital, she's still very ill, but she's hanging in there. And your messages are really appreciated. They mean a lot to me. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.